Hey everyone, welcome back to the channel. Today we're diving into a super important topic that affects investors, companies, and our economy, the stock market. We're breaking down what it really is, how it works, and why it matters. Let's get into it. So first up, what is the stock market? The stock market is a place where people buy and sell shares of publicly traded companies. When you buy a share, you own a tiny piece of that company. That means if the company does well, that share can increase in value. If it does poorly, the share might lose value. It's like a giant marketplace, except instead of apples and phones, you're trading ownership in businesses. Example, companies like Apple, Google, and Netflix are listed on major exchanges, and millions of people buy and sell their shares every single day. So how does this buying and selling actually happen? A company first goes public using an IPO, initial public offering. This is when it offers its first shares to the public to raise money. After that, shares are traded on stock exchanges like the NYSE or NASDAQ, and share prices change based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. So it's not random, it's all driven by what people think the company is worth right now. Next, let's talk about stock market indicators, big numbers that tell us how the market is doing. Dow Jones Industrial Average tracks 30 large companies. S&P 500 tracks the performance of 500 major companies. Nasdaq, known for tech stocks. These are kind of like report cards that show whether the overall market is rising or falling. When the market rises over time, we call that a bull market. When it falls, that's a bear market. Okay, so why would someone buy stocks? Basically two ways to make money: capital gains. You sell a stock for more than you bought it. Dividends. Some companies share part of their profit with shareholders as regular payments. But it's important to remember, the stock market isn't risk-free. Sometimes prices go down and investors can lose money too. So it's about balance and smart decisions. We will use simple examples, like a lemonade stand, to make these ideas easier to grasp. Imagine if your friend's lemonade stand grew so big they needed money to expand. They could sell tiny pieces or shares of the business. People pay money to own those pieces, and if the stand becomes more valuable, the share prices grow too. This is basically what happens in the real stock market, just on a much larger scale. So why should you care? Because the stock market isn't just for Wall Street pros. It affects everyday life. It helps companies grow and innovate. It can help people grow their savings. It reflects confidence in the economy as a whole. That's why understanding it gives you an edge, whether you're investing or just trying to make smarter financial choices. Let's wrap it up. The stock market is buying and selling company shares. Prices change based on demand. Big indexes tell us if the market is up or down. Investors earn money through stock price gains and dividends. It matters for the economy and personal finance too. If you found this helpful, hit that like button and subscribe for more explainers like this. Comment below if you want a part 2 about how to start investing as a beginner. Thanks for watching.